Arrowhead and Zurich have teamed up to offer multi-line package coverages at competitive prices. We're bringing new life to ambulance insurance. Learn more at arrowheadgrp.com/ambulance.
In this interview with Carrier Management's Suzanne Sclafane, Howard Mills, the Chief Advisor for the Insurance Industry Group at Deloitte and a former superintendent of the New York Insurance Department, explains the origins of the NAIC's own risk solvency assessment, the NAIC's answer to Europe's Solvency II, and gives tips for carriers preparing to make ORSA reports.
The United States, the NAIC had their own response to Solvency II, basically saying we're not going to go down that road. We have our own Solvency Modernization Initiative, or SMI, both of which obviously are just dealing with capital requirements and so forth, and how to make sure from a regulatory perspective that insurers stay solvent. You can kind of think of ORSA, which stands for the Own Risk Solvency Assessment, as the area where Solvency II and the SMI coincide. ORSA is a common requirement of both the European construct of Solvency II and the U.S. SMI, and it's really something that the regulators here in the United States have really grasped onto. They've been very aggressive, and the NAIC has progressed at a faster timetable than it normally does in pushing the ORSA. Now all U.S. insurers with a total written premium of over $500 million will be required to file an ORSA with their state regulator of domicile in January 2015. And the regulators here in the U.S. have really seized upon the ORSA because it's really something that they see as their first opportunity to be forward-looking, to be really proactive. As you know, much of the U.S. regulatory exam process in the past has always been retrospective. You're looking back in a periodic exam and things happened 5 years ago. And the ORSA is different, and they're very excited about it. It's a challenge to the industry because the ORSA, as so far promulgated by the NAIC, is very non-prescriptive in terms of what it should look like. They've given general, broad outlines, of course, but the ORSA, as its own risk solvency assessment name would imply, is a very personalized, very individual approach that each company will have to take into their own risks and then report those to the regulator. We're talking to clients all across the industry, and there are varying degrees of preparation. Some companies are well along the path. Some have even signed up for a voluntary pilot program that the NAIC sponsored, whereby they could submit a draft ORSA. Others have a lot of work yet to do. The key thing would be to be, if you haven't already begun preparation, it's probably already too late. You need to start immediately because 2015 is going to roll around pretty quickly. And the regulators are looking for a really comprehensive, very granular, and very well thought out approach. I think it's very important to point out that it's not just the regulators who will be very interested in the ORSA. Of course, that's the requirement, and that's who you'll be filing it with. But a lot of the other very key other stakeholders, the rating agencies, the investor community, as the ORSA becomes more understood and more embraced and then becomes an absolute requirement. And then once the regulators start to receive the ORSAs, the expectation is that they will tighten their prescriptions, that they will clarify what exactly they want it to look like. So it will be an evolving discipline, if you will. And the ORSA is not going to be a static document. It's not something you'll do once and put on the shelf and say, we've completed that. It will have to be updated annually, or even more so if the regulator ever feels that they have a reason to require you to do it beyond annually. They have that authority. So it's something that's going to evolve over time and going to be an ongoing process. I don't know that the companies will ever have to get to the point where they're doing, dual ORSAs. I think that the ORSA that they submit to the regulator will most likely be pretty much the same ORSA that the rating agencies will look at. And I think that actually I think there's a lot of good reasons to want to expect that you don't have multiple ORSAs, because it would seem to follow to me that if you've got multiple ORSAs, what's not exactly accurate in the one as opposed to the other. So I think that they'll want to see consistency, and that's probably the hallmark of a good ORSA. Consistency, but with constant updating and constant renewal and reevaluation. We hear questions from as basic as, how many pages should it be, literally. One of the things that we advise clients is that there should be a very good high-level synopsis at the front of an ORSA. In other words, it should be a document that a regulator or a rating agency or whoever can look at and kind of read like a 20, 25-page synopsis and come away with a very good sense of what the company is facing and what they have identified as their own risks surrounding their solvency. And then, of course, that will be beefed up and backed up with a lot of additional data in the form of appendices or what have you.